We got a great panel today. I want to thank NAIOP for inviting me back again. I want to thank all of you for getting up so early to come and hear our panelists today. We hopefully have a lot to learn. The markets have been pretty rocky over the last number of years, and I think there's a lot of eager faces out there. And so panelists, come on up and take your seats at the podium. I want to really thank the panelists for coming out. It's a lot of time out of their days, and everybody's really busy and working hard these days to keep the wheels on the right path. So we're excited that they're all here. Let's see, that works. Good. So, gentlemen, before we get going here, just maybe give each of you, a few seconds to introduce yourselves and the companies that you work for and your role in those companies, and then we'll move right into the discussion and figure out how to solve the problems that are plaguing our industry these days. We'll start with Milos.
Mic check.
There we go.
Thanks, Tony. So I'm Milos Dajic. I head up Oxford's Canadian investments team. I think Oxford Properties is hopefully relatively well known in the room, but we're a global investor across every asset class. Generally known as a direct drive investor, so we're fully integrated. But my focus really is on our Canadian investments business, so that includes both the formation and execution of our investment strategy.
My name is Richard Weir. I'm Executive Vice President of Acquisitions and Asset Management for Bosa Development. I don't talk about myself a lot typically. I've been with Nat for 30 years, and if you spend 30 years with Nat, you learn humility. We are a private development and investment firm. We're active in BC, California, Washington State, Alberta. I've been in the business for a long time, and Nat's been in the business for almost 60 years.
Okay, Mark.
Thank you, and good morning. My name is Mark Hanna, and I run the real estate team for Nicola Real Estate. A lot of people don't know about what our group does in terms of the wealth management. We're part of a wealth management platform, and we have over 550 employees. And there's 3 verticals at our firm. One is public assets, second is private assets, and the other is real estate. And for each of those, we have an in-house team. So for the real estate, we have, we're $10 billion in assets. We invest in Canada and the US. We have 100 people on our real estate team, and we invest in most of the asset types, industrial, multifamily, self-storage, seniors living. Not a lot of office high-rise, thankfully. But there's a lot of people don't know we're actually quite a big developer. We actually have developed or are in the process of developing over 5 million square feet in Toronto. We're building 3,000 units of residential multifamily in Vancouver. We're building several self-storage properties. So we're not just an investor, we're also a very active developer.
Thank you, gentlemen. These gentlemen are actually very humble. These are leaders of great organizations. They invest capital, both institutional and private. They raise money from the private sector, the institutional sector. They invest it, they manage it, they look after it. They care for it. We've got family offices, and all 3 of them invest on both sides of the border here, and I think Oxford also internationally. So they're really being a bit humble in what they do. So we have a lot to learn from these groups today. It is really, really so exciting. I mean, I was reminded of a great quote by Shakespeare when I was advised of who my panel would be this morning, that some men are born great, others achieve greatness, and others have greatness thrust upon them. The latter being they are faced with great, appearing unsurmountable odds, of which cannot even be overcome, and then somehow through brilliant strategies, keen insights, hard work, perseverance, persistence, they overcome it and achieve greatness. So gentlemen, today we certainly have had a lot of hard times though in our industry, and you are certainly in the position to achieve greatness. So we're all looking forward today to see how you're going to get us through this and how you're going to lead your teams to the greatness. So no pressure at all. All right, so we've all heard about interest rates and how we got here, and there's been a lot of that. It's been going on far too long. This was kind of the buzz for a while. Stay alive to 25. This all started back when interest rates started rising fast, and we'll talk a little bit of interest rates, but here we are. We're alive, but are we still kicking? So clearly things have not improved as quick as we thought they would. So the new buzzword came, wait for the fix in 26. I was sharing this story with some of my US counterparts, and talking about some investments on that side of the border. And they said, yeah, down here, we're talking about maybe wait for Chapter 11 in 27. Clearly a little bit of tongue-in-cheek. When younger people today want to travel, they use a weather app. Back in my day, we looked at a barometer. When the barometer was high, the pressure was high, and it kept all the bad weather out, and we got good weather coming. When the barometer was low, bad weather could come in. Where's your barometer today? Are we out of this? Are we in the middle of it? Is it we stayed alive? Is it going to be that bad in 27? What's your, just to get you guys going, what's your general overview of the markets and where we're at? Maybe start with Richard. He's got the mic ready.
I don't think you can paint the entire CRE space with one broad brush. Different asset classes in different markets are performing differently. People ask me, how are we doing? And I say, well, we got stuff where we're hitting it out of the park, and we got stuff where we're taking it in the shorts. We've got.
Well, we're going to get into the asset classes. Sorry, but
Okay.
but just if we're in that cycle, is it going to go on longer? Is there more that's coming?
Okay. I guess with respect to condo development, which is a big part of our business, the market sucks. The headwinds we're facing now are probably the strongest we've seen in 25 years. Affordability is challenged. Costs are out of control. Regulation's a burden. We've driven investors out of the market. Without investors, you can't pre-sell. Without pre-sales, you can't build. So this is going to be, I think, a multi-year adjustment process.
So maybe no Chapter 11, but maybe even into 28 before we start to see again. So longer. Milos, would you agree with that sort of sentiment?
I wouldn't say 28. I mean, I think wrapping up last year, I had a much more bullish view than I do today, unfortunately, and I think part of that is because of primarily the geopolitical issues that have been happening, and it's less so to do with the economy, but it's more so to do with what's happening with Trump and south of the border, but also our own political situation and not having clarity around which political party will lead. And in my mind, that can look very different depending on who the winner is ultimately. And I think some of that uncertainty right now is what's clouding the investment market. So if you ask me when that's all going to get figured out, I actually think a lot of it will happen this year. So my view would be this is the year where things start to open up, and we're positioning ourselves for that. And we started doing that last year. I'd say we're a little slower, a little more delayed this year than we expected to be. But by the end of this year, I think we're looking a lot better.
So some good optimism there. We like that from one of our biggest developers and investors in Canada. Mark?
So last year was challenging because we have 3 evergreen funds, and we have to strike a NAV every month. And so we were appraising our assets every quarter. And we could see starting late 2023 and well into 24 that property values were dropping, which is understanding given where interest rates are. But we actually saw the property values level off by, say, Q4 last year. So we were optimistic that maybe things have stopped and leveled. And so going to the Toronto Real Estate Forum, had a bit more optimism than the previous year. So coming into January, I was optimistic. And then with Trump coming in, and we have a federal election at some point. Is it spring? Is it fall? It's frustrating because there might be people are stalling on decisions. So I'm worried that this is going to drag out for another 6 to 8 months.
So maybe not more than a year, though. So that's pretty optimistic, I think. And I think by nature, we're an optimistic group. You look at our barometer there, I agree. It looked like it was going to be pretty clear, and then all of a sudden it looks like it could be rainy. So we've got a little bit more to go, but maybe not as long as we thought. No discussion on real estate, commercial real estate. Our industry can really be complete without a little talking about interest rates. Of course, we talked about this. We experienced the fastest, steepest rise of interest rates in the history of central banking. You don't have to pay a lot of attention to these slides. I'm going to clip through them pretty quick. But and of course, that led to declining property values and the problems that we're facing today and the hurdles that we have to overcome. If we look at interest rates here, and this is interest rates in real estate values have responded. So interest rates went up, our values fall. This is cap rates going up. That means our values went down. If you look at the stock market, it didn't respond the same way. It's had the same problems as this is the S&P, I believe, index. It's still going up even though interest rates are rising. But our industry, we can see cap rates have risen as interest rates have, which means our values have fallen. We're responding very differently. So, they used to say if you want to see where our industry is going, make your call on interest rates. So we'll start here with the whiteboard. They've got a whiteboard. If you want to use it, you don't have to use it. Will interest rates go up or down or stay the same? And that's called our industry. How do you see interest rates? Maybe Mark, start with you. If you had a call on that.
Well, I was thinking coming into the year that interest rates were going to keep coming down. I'm encouraged that we've had, 6 rate drops with the Bank of Canada. since June, so trending in the right direction. But in the U.S., which is usually in the lockstep, and we're heavily invested down there, they haven't. Like
Right.
they're 200 basis points higher. So I think it just might be flatlined now for a little while. So I think we need probably another 3 or 4 rate drops to really stimulate the buyers back to the marketplace.
Richard, rates?
Yeah, I think.
Is
we're gonna-
this condo sucking market that you talked about? Is that a lot of that's?
Just being frank. We're
No, but I think
going to
it's
see. Look, we've seen relief in the Bank of Canada policy rate. We haven't really seen much relief in the bond market, and the bond market is where mortgage rates are set. I think we've settled into a pattern of 5-year money. It's going to be somewhere between 4 and 4.5%. I don't think that's a bad thing, but I think that's the new reality. I think the ultra-low rates between 08 and 22 were an absolute aberration, and this is what we can expect.
When Milos, when you're in conversations with your institutions and you're trying to get them to invest more capital, they talk about interest rates. Is there a consensus where the institutional world sees these going? Are they different than?
I think it's less now about interest rates and it's more sort of spread that we're getting on that rate from a cap rate perspective. But I mean, I think my view is, and if you look at that chart, they've been coming down for decades, right? This isn't just, obviously over the last 5 years, there was an extreme during COVID.
Yeah.
But I mean, I think structurally, it's pretty hard to argue that they can go any lower. And I think I kind of agree with the panelists that it's probably in and around where it is today. But I do think there's risk to the upside and maybe another 50 basis points higher. But it's certainly not going lower in my mind. It could go a little higher, but we're probably getting close.
If you look at this slide again, this is kind of where interest rates are, where they're going. If you drew a line through kind of where they are now and going back, they're kind of lower or kind of where they've always been. Can we say and interpret that as this is maybe a new normal and we better figure out how to work within it? Mark, what do you think about that?
Yeah, I do think that I think they're going to flatline for a while. I don't see them changing dramatically until we get through this uncertain period right now.
So this is the world we have to live in, and if we talk about spreads, then our values have come down. Are they down enough, Milos? Have we written them down enough? Are we there where we can start trading again, please? Just kidding.
I don't think so. We're not quite there yet.
Okay.
We're getting there, though.
Okay.
Like, I think last year and the year before were years where everything moved in the right direction. We've certainly written down our book, and it's reflective of our results right over the last couple of years, which have obviously not been great. So we've taken our medicine, right? And I think I can't speak for the whole ecosystem in real estate, but I think it's certainly working its way through the system. But I don't think we're quite there yet. But again, we're getting closer.
And if the institutions' sort of cap rate thresholds are continuing to edge up, it just makes it more and more difficult as a developer to be able to develop
That's your exit,
at a
right?
price where you can make money.
Yeah. We're finding that. Mark?
We're developing a lot. We rely a lot on debt, and it's floating, and it's expensive. And then you layer on the, all the development cost levies on top. It's very difficult to justify new development.
Yeah, we're going to get into some of that a little bit later, but the interest rates still are a very big factor in the industry. And if they have reached a level, if we look at that last graph and they really are, this is where they're going to stay, then I think that we've got a little bit more room to stay on the values, and then we can get back to trading within that marketplace. It's taken a long time for people to shift their values levels down. All right, well, thank you for that. We'll move on to interest rates because I think there's a new enemy in the market that seems to be even bigger or greater impacting our industry than that of interest rates. And that is sovereign risk. This is risk that you have when you're investing and you don't know what the heck your government's going to do next. Not every government is as progressive as the Mayor of Surrey today. So we face risks all around the world. We've got ground war in Europe. We've got a war in the Middle East. We've got problems with China, and now we've got a new president south of the border where we do some 80% of our trade. That's threatening tariffs, and then of course we never know where these tariffs are going to go up or down. So it is a big problem. But there's a lot of different sovereign risks in the market. We've got development fees going up. We've got capital gains are in, then they're out, which is a big part of what drives our business. People invest in real estate because there's a capital gain there. Speculation tax, vacancy tax, carbon tax, and on and on and on it goes. And I think of course, the tariffs are in and out every day. They're different. Is I guess the question here, we got a new leader, one resigning, one coming in, we know he's coming. The barometer getting pretty cloudy. is it up and down with sovereignty risk? So I guess try and not to really put you on the spot, and I know this was a bit of a change, but the more I thought about today, this to me seems like the bigger risk because we really can't control them. There's just too many factors, and the government has really been in there trying to fix it, and they've really made it worse in most cases. What is the strategy to deal with sovereign risk? And you know, Milos, we'll start with you. I mean, you have to get asked this all the time by your pension fund clients. Well, what if we did? Where do we go? Like, you have some optionality. You can go to Europe, you can go to the U.S. So you don't have to be here.
Yeah, I mean, I think it's an impossible question to answer because I think the strategy is to wait and to kind of, not look. I think it depends on the risk you're willing to take as an institution. Our capital tends to be a little more risk averse. I mean, we're pension plans, so we're not trying to hit 30% IRRs. We don't need that, right? I mean, it's obviously a barbell approach, but overall, I don't think we're going to get paid right now to speculate on sovereign risk. So my strategy, or like the way we would deal with this, is likely to wait it out a little bit and see kind of what kind of clarity we get in the market. And I think that's frankly what a lot of groups have been doing. Now, I think if you want to get ahead of that and make some big bets right now, you could probably make a lot of money. I think that's not really in our MO to speculate on it. But it's a really good question, Tony, and it's creating a lot of noise right now across the board.
So a big pension fund saying we're going to wait. Surprise, surprise.
But I mean, look.
No, I'm just teasing.
Wait in Canada, right? But to your point on global investing.
Yeah, so what about other countries?
We've been investing in the U.S. in a pretty big way, and we've been playing in credit, so that's another way to kind of mitigate a little bit of the exposure, because on the credit side, you're taking naturally a little bit less risk. So the unfortunate part of that has been less capital coming to Canada, more capital going to the U.S.
And there we have it. Our money flying south of the border or across the pond. Richard, you also invest on both sides of the border. Can you answer this? And what are you doing?
Yeah, no. We've been investing in the U.S. for 25 years. We have a platform down there, and our focus has shifted into the U.S. Right now. We just see more opportunity, more stability. Milos talks about the risk aversion of the institutions. I can assure you, we're very risk averse too. It's our money, and we hate losing it. And to Milos's point as well, we're taking a very cautious approach about Canada at the moment, and the U.S. Even though we are underway with a couple of developments in the U.S. right now, we're generally cautious. There's not a lot of visibility on a lot of the issues that you've raised, and absent visibility, it's a good time to be cautious.
If you were going to invest, do you agree with Milos? Would it more likely be south of the border?
We are. Our focus right now is all U.S.
Mark?
I think last Monday when they paused the tariffs, there was some common sense in the room, and then this Monday he put tariffs on steel, and I think everybody, how can you trust this guy? So I was down in the U.S. all last week in Vegas and Phoenix. We have a lot, decent size industrial footprint in those markets. And I was at an event that was hosted by one of our developer partners on Thursday for 3 hours, and it was probably 70 capital groups that invest down there in that market. And I was probably one of the few Canadians in the room, and all of them were concerned about tariffs and what it's going to do to projects. And so, we're an active developer in both markets, so now we're trying to plan projects. We're trying to figure out costs. Are they going to go up? Are they going to go down? And I think this is a real wake-up call for Canada to get their act together. I was at an event last night and at our RBC, and somebody reminded me that one of the speakers is that we have tariffs in between our provinces, which doesn't make any sense. So we're going to have to really get our act together and work as a whole, all three levels of government, and eliminate those if we're going to compete. Otherwise, we're going to be stagnant for a long time.
Yeah, it's interesting to see the tariffs. They're so connected, right? I mean, if tariffs go up, then costs go up. Costs go up. You got inflation. You got interest rates going up. Like it's really kind of crazy stuff. Richard, you're very political. I know that. A lot of people are saying, look, this tariff thing, which is really the biggest of these sovereignty risks for our immediate impact, at least in our industry. Obviously, a global war would not be good. But Trump's just negotiating here. He's art of the deal guy. Like, is this just, he's not actually going to do it? What do you think about that?
You want me to tell you what Donald Trump's thinking?
No, but I respect your insights in politics. I know you're very political. Your degree was in political science, I think.
I have no idea. It's been just.
But is he just negotiating, Milos?
I don't know.
I'll speculate. I would say likely is probably, if I'm
I mean, a tariff hurts them as much as it hurts us.
It's a way to bring people to the table to force issues, right? And he's making it clear that he's going to use tariffs over and over again with different countries for different reasons, just to get what he wants, right? And I think that's he's basically kind of a bully, right? And he's using the one economic tool he has that he knows hurts others more than it hurts him, at least in the short term.
What's a couple of things that he wants? Stronger borders?
He wants us, Canada, to step up on defense spending.
And should he?
He wants
Should we?
Canada to step up on trade. He
think-
wants our oil for free.
I think he wants to bring Canada to its knees, and he'll keep saying over and over that he wants Canada to be the 51st state until it happens. He will do that. He will not stop on that. So I think we've got to that's what I say, we've got to get our act together, and we need to be more self-sufficient. We're always going to rely on trade between Mexico, U.S., and Canada. That's not going to stop, but I think we need to figure out how we're going to handle our affairs here and trade with other countries and not be so reliant.
Well, there's no question that the sovereign risk that we face in terms of everything from municipal costs, taxes, and lead times never affect us a great deal, and they affect interest rates. But I don't think there's ever been a time in history that the sovereign risk has been greater because of all the uncertainty out there. And I guess Milos was pretty clear. He's going to wait and see. Richard, same. But maybe the U.S. is a safe investment because it's more
Safer, but we're builders of large projects in the U.S. Steel and aluminum tariffs are going to hit our costs.
Mark.
We're still building. We're going to keep going. But I do think it's you got to keep repricing your projects out there because the costs are going to be fluctuating. We're very active in the U.S. That's a market we like. We're going to still keep investing down there despite Trump and the tariffs. But but we're building much more. Our activity for development is all in Canada right now.
All right. Well, I'm sure we should have a politician on stage to really take this topic to as deep as it should be, but we'll move on, and that's about all we can do. We have to be aware of those risks, and again, as I said, I never seen a time when this risk was something we had to think about more than even where interest rates are going, and how connected they are. So let's move on and talk about the investment market. So in general, so if we look at how it's been performing in the face of all of these obstacles that we just discussed, we see that investment sales are down. This is a measure of activity. If we look at our projection on investment activity, we can see it's down. We're projecting it to go up a little bit this year, but still down. We're seeing most of that activity still comes from the private sector. The black you see there is the private sector. And you can see they're down, but we're getting some balance. But still, the private capital, which Mark and Richard work in largely, is the most active, maybe perhaps more risk takers. And then, as a result of this interest rate discrepancy that Mark referred to earlier, we've got the Canadian dollar dropping and likely dropping further. So maybe that could lead to foreign investment in our market, and there certainly has been a lot of that. So just talking about, the barometer for investment, do you expect that as these values have fallen, we've written them down in the face of all this risk, that your investor groups, different with Richard because it's private family, will start to say now is the time. Let's get in there. There's some real opportunities. And we're going to get into each asset class in a second, but are the foreigners going to buy up our country, or are we going to compete with them? Are they going to see value or we don't? Milos?
Look, the short answer is we are prepared to start being much more active, and I think, on that slide, I think I saw pension plans and institutions as a tiny sliver.
Well, this is all foreign investment. This is all recent foreign investment. So they are coming in here and seeing value where, we're not really seeing that kind of enthusiasm from our typical domestic investors.
But I think a lot of us are on the sidelines, but we're ready to kind of go, and I think, I'll say it again, I think that will change over the next year. We've got a lot of dry powder that we've accumulated over the last several years. And our deployment target for the next 3 years, and in particular this year, is in multiple of billions US dollars. So it's going to be a significant push to try to put out money and capital. So I would say I'm optimistic about the investments market, and it's underpinned by actually pretty good operating performance across all of our assets. And we've been fortunate to own one of the better portfolios, I would say. Across pretty much any asset, we tend to buy highest quality, and over the years that's cost us more, but it's tended to perform through cycles. So notwithstanding a lot of the uncertainty, because it's probably sounding a little bit negative, and I don't want to be overly negative. I mean, there are some sovereign risks and geopolitical risks we're dealing with, but overall, I do think that'll we'll get some clarity on all those issues. We're going to have an election this year in Canada, right? Like, that's happening. It's happening by October. Hopefully it'll happen earlier. That's going to be a huge help. We're going to figure out what Trump wants to do. It's going to come out over the next couple of months, and we'll see what he really wants. To your question earlier, Tony, he'll make that very clear. And by the end of this year, we'll have more clarity, and I think we've got money, and the markets are looking, I'm very optimistic about the next couple of years, because I know that we're sitting on a lot of capital and we're ready to go, and we want to deploy it across effectively almost every sector. Like, there's almost
We are
no
seeing
place.
activity leak into this, so that's great to hear that, and hopefully that's Richard. Again, foreigners are buying up our country. We can't operate. In your world, foreign investment, the inability for foreign investment to be shut off. They no longer could buy condos, so you can't sell them, so you can't build them. That's the kind of thing that affects us here with the foreign investment. They cut it off.
It does. Foreign investment's a good thing.
Yeah.
Unfortunately, that message has been lost on the federal and provincial governments.
Capital is fluid, right? It can go anywhere, and you start putting rules and regulations in that they can't come here, then we've basically shut down our housing industry.
We've talked a lot about Trump. What's one of his biggest objectives? To attract foreign capital into the United States. Why don't we try and do that in Canada?
So are we doing those things? Are we lobbying hard to our politicians to rethink these strategies?
Tony, what do you think?
There's some good groups out there. Mark?
Says it's a great buying environment, but I'm not seeing it. Anything that's top quality, it's not being discounted. I think what has happened is land has right-sized in Canada, which is good. So it now starts to make projects more viable. But in 2021, which was an anomaly, but that was a busy year for us. We did $2 billion in acquisitions. We did 90 transactions. And so you could buy assets and they made sense and debt was low. But fast forward to today, we're preserving capital to do build-to-own projects. We can build them at a better outcome than trying to acquire the same quality assets out there, because they're not on sale. They're still, Tony, you're active in the market. You're seeing it. There's no severe discounts for the quality product out there.
Yeah, some of that is perspective, right? We do see this foreign investment coming in, but locally, Milos is saying wait. We're all saying we're going to invest south of the border. There's better opportunities there. Our values have dropped quite significantly over the number of years, and there's capital, and activity's kind of moving a little bit. So they got to drop further. Our values got to drop further. Now, you guys are also, as investors, you also own a lot of stuff.
We do.
So you don't really want to see that.
But I think to Mark's point, I haven't seen any screaming deals. It's, the good stuff's not really on sale. And maybe that speaks to the stability of the ownership structure in Vancouver. But
there are groups, right?
There's opportunistic deals out there, but there's a lot of risk associated with them.
Well, I got to save this for later, but I was going to say let's shift to Alberta, but we'll save that. But there are opportunistic deals out there. Maybe they don't exist in Vancouver. Vancouver has traditionally been one of the stablest markets in through all these. I think this is the fifth major cycle that I've worked my way through, and the message we always give to the market, and I'll let you comment on this, is that when these periods of turmoil come in and assets values fall and there's opportunistic buying, Vancouver doesn't respond like every other market. Our fundamentals are better here. We don't have land. We have lots of people. And so what becomes the opportunity in Vancouver is availability of assets, not pricing, whereas you might get a great deal in Toronto on condos. I think there's under 100,000 for sale or something. But here, you don't really get that. So if availability is the opportunity, if I can sell you on that concept, shouldn't we be buying something in here? Because you're not going to get it again. Mark?
That's why we have decided to invest in core markets like Toronto and Vancouver, because when difficult times, you want to make sure those markets hold their values, and they have. And so we're going to continue to be heavily invested in those markets. So I don't see, you go to the smaller markets, you can get better returns, but that's where they fall the fastest. So I think we're going to stick with our principles in terms of investing in Vancouver, Calgary, Toronto,
But not at these values yet. I think that's what I heard last time.
Yeah.
Not quite at these. They need to fall further. So the opportunity of availability is not quite going to get you off the sidelines.
People are hanging on to the old valuations. They're not ready to part with them. It's you
Our
work too hard to
cap
get
rates
those
have- our
assets.
cap rates have moved. Come on, they've moved down a lot.
No, they
in
have,
every
but-
asset class.
but it's-
We're going to talk about those in a second.
Tony, do they need to fall further, or does there just need to be additional capital available to help finance acquisition?
I think we've heard
You
from
can get
everybody.
positive leverage
I think we've heard
on
from everybody here this
AAA
morning.
assets.
Yeah, there is positive leverage, and that's, boy, we sell that all we can, but that spread's pretty small right
You
now.
also need, like, and to your point earlier, you need more available product to come to market. And, you know, if I look back at the last year, like, it's not like we missed out on a lot of big deals that were interesting. There just hasn't been that many, right? So the market's been, so what could probably drive cap rates higher is more people coming to market to sell, but actually being real sellers, right? Because we've seen a lot of stuff come get tested and then get pulled because, you know, the seller doesn't like the bids. And, you know, it's funny because you talk about Vancouver as being kind of the safe place in Canada, or one of those markets that if you're Canadian, you understand why it's expensive, why it's hard to grow here because of the stability that you get through cycles. If you zoom out globally, Canada kind of has that, plays that same role for a lot of global investors. It used to be, right, the place you would invest because it kind of makes it through cycles. In 2008, Canada was relatively unscathed. Well, you know, the rest of the world felt a lot of pain, especially in the US. And that really, we came out of that looking like all-stars. And I think foreign investors, the reason they weren't here is because they couldn't really compete, right? Because domestics would just buy everything up. But Canada had that reputation. Now that they can compete because the domestic capital has kind of dried up, I'm not sure they want to anymore because now we've tarnished our reputation a little bit through all the stuff we've talked about. So I think that's kind of another challenge with foreign investment.
Okay. So if that's the state of the investment market, where we got to get our values to fall further to get the domestic investors off the sidelines, you know, we got to rely, I guess, on foreign investors. So I guess we're going to still see spotty for the next little while in the overall investment market. It's probably a good transition into falling prices to go into start talking about the asset classes. You know, let's talk about land. Land typically in these environments falls the fastest and falls the quickest. You know, we can see. You know, again, I'm embarrassed because I'm standing right in front of the mayor. But if you look what's happened, as well as rising interest rates and falling market, you know, you can see what's happened here is a Greek mythology of Sisyphus who keeps trying to roll a rock up the hill and keeps pushing him back down. But if you look at the things that have weighed this rock down, all the municipal, the federal taxes, some of the sovereignty you talked about has done to create this difficulty of getting land through the system and getting it. Getting it to a place where you can develop it and where it's profitable, it's been pretty tough, right, with land. So you'd think that would be the next sort of great investment. At least and we've got construction costs have gone up, adding to the long municipal lead times, adding to the municipal costs. These are construction costs. Then we've got lengthy timelines. We're one of the longest in the city. We've got, and then we've got a result. We've got the highest level of receivership sales of land that I've seen out throughout my career in any of the previous cycles. So maybe land has fallen. And so are you buying land? Let's talk about that. I mean, if there's one asset class that has really responded, contrary to what Mark has been saying, that assets haven't fallen enough, this one has. Are you buying land, Richard?
Not yet.
I got more receiverships in the history. When is it going to be low enough?
If you're buying those receivership deals, you're speculating. If you're buying to develop, the numbers are still extremely challenging.
Gee, you got to come on. I mean, at the peak of the market, and this probably won't resonate with everybody, but there was land that traded in the downtown core that touched on 800 a buildable square foot. And we all remember those deals. They were the last deals. You can now probably get decent land downtown well below 200. That's a pretty significant move to my part. Where do they got to go to get you in?
Well, I mean, look what's happened to the top end of the market. You know, what traded at $2,800 a foot is clearing at $1,600. Do the math. With construction costs where they are, all the additional costs burdened on top of it, $200 a buildable is still pretty skinny.
Mark?
Yeah, we're seeing land drop. There's price discovery, as Avtar would say, on land right now, so we're optimistic. But when you acquire land, you still got to work it with the city to get the density, to get that per buildable square foot down to make it make sense. I think the other challenge is we need a total rework of how we pay these costs to the city. I mean, paying them up front it really stresses your project. If we can pay them partway through or at the end, it's going to help get more supply to the market, especially for whether it's condo, which is your shadow supply, or our multifamily rental. I think the other topic is, I don't know if we're going to touch on it today, is affordable housing. I think it's a joke when you call affordable housing 10% below market. That's a joke. Affordable housing is 60% below market. That's what we need to do. And the only way you're going to do that is if you get help from all three levels of government.
Yeah, I got a whole topic on that, and maybe we can get into some of it in a second. But yeah, I mean, so, well, land, 60%, I mean, you're going to have to get land for free. And you're going to have to get no property taxes for 20 years. You're going to have to get a whole concept that's going to be different. We need the mayor up here, and we have to have a one-on-one with her and some of her colleagues to really figure out how we can get affordable housing.
Three levels of government. You need three levels of government working together. That's never happened. It's got to happen. We're never going to get there unless they do that. I've written an article on this a year ago, and until they start working together, we're not going to get there.
I mean, I agree. Richard?
I can't.
Land's not cheap enough for affordable housing, but land isn't cheap enough. Let's stick with that for a second.
Yeah, land's not cheap enough. Land's not cheap enough because on the demand side, the buyers aren't willing to pay enough for the finished product to make a pro forma work. So that's why I said not yet.
So for the lenders in the audience who have these loans that are touching on values, beware of the future here of the buyers of land. Milos, land?
I'm swimming in land in our portfolio, so that the last thing I need is more land. So we're probably not the right group to go out and buy it. But I think for a lot of, the math you just explained is the exact math. I mean, there's a number at which it works. It's just not low enough today, I think, across the board. And for a lot of groups like ourselves, land is just not helping our portfolio. Like, we need income today, right?
But you're a developer too. I mean, that's a big part of your organization.
But when we look at our total return is what we're trying to target for our shareholder. Right now, land would be, whatever, call it a 3 to 5, 6+ year drag on our book, right? Which isn't contributing, right up. And again, we have a pretty big land portfolio across almost everything. So we'd probably be surgical in where we want to add specific positions. But for the most part, we have a lot of land we need to chew through. And the focus over the next few years is really getting income. And we're probably not alone in that sentiment, which is probably also driving a little more negativity around land generally.
Tony, just let me end on a slightly optimistic note. I don't want to be completely pessimistic here. I think
what hasn't been optimistic about this talk?
one of the challenges with land has been that we've all gravitated towards large, multi-phased development sites. I think in the current context, smaller boutique projects are much more feasible.
Okay, so is that a risk because if it's smaller? You're gambling a smaller bet?
The risk is smaller. Look, wood frame is cheaper to build than concrete, pardon me, and the market's not differentiating at the end value to the extent that it needs to. And the problem with the multi-phased developments is the carry cost on the land, and the inability to generate the kind of absorption that we've seen in the past. So better off to bring something to market now that you can sell to a local user buyer market, and that you can generate enough sales to actually get it financed and get it built.
Plus the time that it takes to get a property to market it, 3 years before you put a shovel in the ground. It's unacceptable.
But there's something new in the market now that we've got. Not only are these prices down, I can get you time. I can get you like 6 months conditional period, a year closing. Is that not going to help?
It's years, Tony. When Nat did
not in Surrey.
No, when Nat did Citygate 30 years ago, from acquisition to first occupancy was under 2 years. Today, most optimistically, that's 5. So you getting us an extra 6, 8, 10 months on the front end of an acquisition doesn't fundamentally change the problem with timing.
Yeah. What's led to some of that? I mean, this is really not on the topic, but is it the ESG? Is it trying to get green? Is the new building codes?
Policy creep.
The planners can't even give you approval because it's changing all the time. The codes are changing, their rules are changing. What's taking so long? Why? It seems like pretty straightforward. There's a building code. You go and meet it with a plan with an architect. It should be like couple months. Why is it taking so long?
Building code, for example. I mean, it's very well intentioned. But let's look at the new policies regarding adaptability of units. Very well intentioned, but it's adding 5 to 7% to the size of every unit. That's directly increasing the size of, or the cost of every unit by 5 to 7%. And there's been this creep in building code. It's let's add a new policy every year. And it's just compounding the challenges with costs.
Is this, yeah, we don't have a politician up here, I won't ask. Is this politicians just trying to get elected or really trying to save the planet? It's hard to understand because we kind of need houses to live in. And it seems they've kind of gone overboard. Apparently the only market that's worse than Vancouver is Toronto in terms of lead times and costs. What do you see over there? Is it similar problems or?
Yeah, I mean, it's quite similar, and I think policy creep is probably the best way I've heard it described, and it's probably right. I mean, it's every individual policy doesn't feel all that big, but when you kind of step back and you look at it all in aggregate, it starts to feel like it takes forever to get anything approved. So yeah, we're seeing very much the same issue, and I think our condo market might actually be just as bad, if not worse. So yeah, I mean, look. To me, it always comes down to economics. At the end of the day, I think we can still figure these things out, but land needs to get cheaper, financing needs to get cheaper, and I think certain programs like we've been leveraging, like CMHC, and so the government has been helpful in that respect. And if you have land at a low enough basis on your book and you can get high LTV financing for a 10-year term at effectively the cost, the risk-free rate, you can make projects pencil. And that's what I think that's where we found success in our kind of built-to-rent program. However, if you look at kind of the unlevered metrics of those projects, they're not great. So you have to kind of plug your nose and rely on the leverage, and it kind of bails you out. But there's signs of life through that for us.
Well, land has to get cheaper. That's a bit chilling because the people here that suffered receiverships and didn't quite survive to 25 are not going to want to hear more of that. So it's interesting take on that. I'm not sure how far land can fall, but we heard it here today. So that moves into multifamily. That's a good transition because you buy the land to build multifamily. That seems to be the favorite asset class. We now look at land primarily. You're under pro forma. You're going to sell the condos at $2,800 a foot, $2,500 a foot. You can pay this $800 a buildable foot for the land. All that's changed. Now we can't sell any condos at any price. So now we run a land pro forma. We can sell it as an apartment building, as a multifamily building, because we still have a market for that. So let's talk about multifamily. Theoretically, we're 400,000 homes short throughout the Lower Mainland. If you look at the affordability of buying a house, basically this is the average income you kind of need to buy a home, buy a condo, rent an apartment building, and then there's the average income, and basically what this is saying is nobody can afford anything. So you're gonna be worried about averages, but we got an affordability issue, we got no houses. That should be a market that's just welcoming in lots of development, no opportunity for development. We're seeing government trying to get involved, but now they're saying, now we're going to cut residents because that's the problem. There's too many people. So that's going to affect your thinking. Where immigration is going to be down, they're projecting to be falling further in the next couple of years. If that affects your opinion, and for the first time that I can remember ever, we've seen rental rates kind of come off. You can see that's the graph there showing rental rates of new apartments. So when you work these pro formas now for multifamily, that leads into land, you got to change your rent. You got to rethink your rental rates. So that's. So what's your What's your thinking about multifamily? Are you going to invest in it? Are you have capital for it? Can we move some land through the pipeline by building rental accommodation, Mark?
Well, we're building a lot of multifamily.
Yeah. Okay. Go ahead.
But and certainly the federal government waiving the GST on multifamily was a good positive step. We need more contributions from the province and municipalities, but there's a housing shortage, but not necessarily at the top end, right? So if you're $5, $6, $7 a foot, that's expensive. Not everybody can afford $2,800 for a one bedroom or $3,800 for a two bedroom. So we do need to focus on some more affordable housing and to the marketplace. That's where we're short. But we're going to continue to build multifamily, and what we're seeing now with product that's coming to the market is, lease-up time used to be maybe 3 to 4 months. It's probably like 9 to 12 months to stabilize your these buildings now. So you got to have a much more patient approach.
Richard, a lot of condos in the past built to hold multifamily now? Built to sell?
No, we look at it all the time. We have a large land portfolio. we'd love to build through it. And we were looking at it last week, as a matter of fact. Okay, what if we do maybe some forward sales of multifamily buildings? And there's no margin. I mean, for us, we're high-rise builders. Hard costs are $500 a foot. Throw in your soft costs, which have gone up because of interest rates. And, you know, we can't make it, it's a struggle at $5 a foot on rent. And to your point, we're seeing disinflation on rent. So we're basically building it and selling it at cost. And, I mean, you know, maybe it's fun to be busy, but we'd rather not be busy if we're not making any money.
What makes it attractive, though?
Really?
Is the
That'd be surprising to everybody in the room here, right? But the politicians seem to think you should be building, even if you can't make money.
So for rental, certainly what makes it attractive now is CMHC financing, and who would ever thought that we would have 50-year amortization for apartment buildings? So that certainly helps.
But
Try it.
justify
Yeah.
But Mark, as a buyer, your cap rates are, you know, you've moved your cap rates up. Your expectation on multifamily is what, 4.5? Core multifamily?
Ideally.
We can't make any money building it and delivering it at a 4.5. So
That's if you're buying. You say if you're selling, you're building it and selling it to Oxford. It's
correct.
4.5, and you can't make money at that.
Correct.
Right. And are you building to hold, Milos?
Yeah, I mean, that's a huge part of our program, and we're fortunate to own a bunch of land, especially around our existing malls. I mean, we've got a site out here in Vancouver that's under construction now. It's going to be delivering in a few months. So we're definitely building. Multifamily, to me, is one of the best sectors still for us. CMHC is helping. I think without CMHC, it'd be a very different story.
So CMHC's been a big factor in driving that multifamily development business, and yet they just threw a big lump of coal in everybody's stocking at Christmas time when they won't fund the last piece of the pro forma until you fill it up. So now you got to go find secondary financing for another 20%. So they kind of give and take. Gets back to the sovereignty risk at the beginning. How does the developer move forward with all these changes that are happening so quickly? So multifamily, that should be the safe haven, right? This is, I'm not going to leave this topic yet, but this is Peter Lindemann. He's a big economist in the States. He's a big, well-respected advisor on the real estate trends. He's on numerous podcasts. I go everywhere. And his view on multifamily, now maybe this is U.S.-centric, is to stay wealthy, invest in multifamily. And we're going to talk about other asset classes here. And yet you can't build it. You're buying it, though, right, Milos?
We're trying to buy it.
So is it got to get cheaper, too? Is there a theme here?
The problem, I think it's actually lower than that in most markets, right? So ideally, we'd want to be buying at a 4.5 plus, closer to a 5. Obviously, that's not where it's trading, right? I mean, you're probably closer to a 4 in a lot of markets where we want to be in. If it trades, and there's not really a lot that's trading, right? I mean, we're looking at mostly.
So you'll buy at a 4?
I don't know. I don't think so.
Because I got time right after this meeting.
and we can't deliver it for a 4.
At 4. If I can trade it out at 4 to Milos, you still can't build it, even with the land you have that you're holding for a long time.
A lot of our peer group would tell you that the only way to make it work is to write your land down to 0.
Mark, just build to hold.
Yeah, we are.
So you don't have to trade it out at 4 later.
Yeah, we have a merchant fund, so we do some build to sell, but predominantly we are building to own because we can't pay to buy new and shiny and make it work in our fund. So that's why we're building that product in our fund.
We can talk about this. We need a whole session to talk about this topic, but we have to move on. But just to finish up, again, I'm really curious about what goes on in those boardrooms with the institutions when you're in there and you're, I guess, soliciting capital, for lack of a better term. Milos, is multifamily on the minds of the institutional investment groups these days? They want, go get me some, but here's the yields, and then you say, I can't. Like, how does that, is it an appetite?
100%, yeah. It's our probably second or third, top 3 conviction thesis right now is multifamily, so it's up there. But exactly as you said, it's the yield, right? So that's been the challenge. And a bit of the noise right now in Canada around the immigration story, right? So the numbers are not looking as good as they were before. I think if you dig through some of that, you get a little more comfortable with it because the people you're losing are not necessarily the ones you're worried about.
Yeah.
But to answer your question,
well, there's a basic fundamental shortage that exists. Forget immigration; it's just there. So there should be an endless pipeline to fill it. If we're 400,000 homes short, technically.
yeah.
Okay. Well, we probably should move on to get through all of this, but. Something that we need to consider, and I think, Mark, you're on it, and Richard was on it, and the industry should be on it, is we actually can create something called an affordable housing as an asset class. where a developer like Richard can actually go in and buy some land, or get some land, we'll talk about that, and build it, and to a same profit, he'd build market housing, but make it affordable. And that would require, as Mark said, all three levels of government to say, look, the feds can say, no property taxes for 10 years. And maybe the people selling, no gain, no tax, no capital gains tax, no tax at all on your gain. So we get some land trading up at cheaper prices that you need. Maybe the municipalities can say no DCCs, but you give me 25% below market rents for the next 30 years, and we create an asset class where people are buying properties, trading properties, building properties into an affordable, and now we're not talking, social housing necessarily, but affordable housing for the service sector that we need here. And we could create an asset class. It actually exists in the United States of America if we get all three levels of government cooperating. Governments could throw in land, provided you give us this affordability for 30 years. So let's think about that as we go away and move off here as a way to maybe get some housing in here at affordable prices that people will build without having to drop the price of land too much. So where are we at here? Where was it? Office, there we go, thank you. So office has been pretty much a black sheep of the investment family for a little while. We had COVID, we had work from home, we had a lot of oversupply. Let's just take your take on office. I'm going to save Mark for last because I sort of know where he stands. We've had lots of conversations. Milos, you're a big office owner. What's your take on office? We had a little conversation before this about that.
Yeah, I mean, I think as a big landlord, one of the largest probably in Canada and globally, I mean, we own a lot of office. We've been fortunate to own some of the better quality product that, frankly, we haven't felt the pain that some of our competitors have. So, overall, I would say we're finally starting to have conversations at our investment committee around potential office deployment. So it's resurfaced for a few years now. It's been very much like a bit of a no-fly zone. Now it's being talked about both from a credit and even from an equity and maybe even development perspective. So I would say we're starting to look at it again. And, and we talked about Blackstone coming out with a big kind of statement about office coming back. And, for what it's worth, whenever they've said anything, whether it was industrial or not office, like people tend to kind of follow that capital. So there's something to be said about that. And I think from my perspective, it's an absolute critical asset class for us, and it always will be in our portfolio. The reason you might have seen us selling more than buying over the last several years is because we used to be, 50, 60, 70% office, right? So we're just trying to kind of diversify our portfolio more. It has nothing to do with the call on office. I do think kind of the worst is behind us. Kind of like with retail, it took a long time to kind of bottom out, and now it's kind of back again. We're not quite there with office, but I think it's heading in that same direction.
Well, let's just look at this. Everybody in the room here is pretty much, well, I think everybody here is pretty much from the Lower Mainland or Vancouver, and I'll get you guys to answer the same question, but let's look at a couple quick statistics here. Vancouver has one of the strongest office markets in terms of vacancy and fundamentals in all of Canada. We've got obviously typical, this is B space versus A space is a little higher, but technically overall the market's pretty strong. If you look at this graph, this is my favorite graph. This is where I can sell an office building in Vancouver. There's lots of buyers out there, by the way, for this asset class these days, because a lot of people are seeing the positiveness of it and not a lot of sellers. But we've pretty much all the space we built was absorbed. That's the black that you see, the new supply, and then the absorption is, and so you can see nothing is coming. There's no black coming. It takes a long time to build an office building. It takes a long time to get it approved, a long time to get it up, and then a long time to fill it up. So we really don't have any buildings coming for at least 5 years. And if we get even modest amount of absorption, this is going to be a very powerful, this is going to very, very quickly slip into what we call a landlord's market. We get below a 10% vacancy rate. So, you can look at the buildings that all filled up. These were all built. And then some of which, here's Oxford, the stack. And then you've got what can come on. These are all the buildings that are ready to go, development permit ready, held by mostly strong developers. Nobody's going to build. So would you buy office? Milos, you answered that, Richard. Would you build office? So maybe it's a better question for Bosa.
Well, I think flight to quality is a cliche, but it very accurately describes what's going on in the office market. I think tenant demand has stabilized and is coalescing around the best space in the market. I think the Class A occupancy rate in Vancouver is over 90%. Would we be buyers of office? No, not right now. That's not really what we do. Would we be builders of office? Probably not, just because we would face the same cost constraints that we do on the multifamily site. But for the institutions, I think it represents an opportunity, particularly at the top end of the market. And to your point, Tony, there aren't that many trades. I think you sold a building for Oxford last year, and to my knowledge, that is the first building that's traded in any major market at anything close to sort of historic value. And I think that speaks to the appetite for, Class A office in Vancouver.
Yeah, there is quite a bit of that, but you're not a buyer, but would you build one?
Like I said, we would face the same cost challenges on office right now that we would on multifamily or condo. And would we build? Sure. We had good success with 320 Granville.
Great success.
Would we? Yeah, I think we'd need a lot more confidence on the demand side.
Mark, let's hear your take on office.
Let me be clear. I hate office.
I saved it for last for a reason.
Hate it. I'll give a shout out to both Milos and Richard. The Stack is a fantastic building. Our office is across the street. I think it's one of the finest buildings, and they should be proud of that. And then with Richard and Nat, when the building they did on 320 Granville was brilliant. With the
Home run.
lower half is Strata Industrial, and the upper part is lease. I think it was a brilliant deal. Many decades ago, when I started my career, same time as Tony, I was a leasing broker. I was a listing agent, and then
So
eventually a tenant rep broker. I know too much. So, and now today, and even though Vancouver is definitely probably the best market in North America for office, it's probably got the lowest vacancy, and there's still the inducements are high.
These are some office trades in the last couple of years. And this is a downtown, and this is suburban, so there's about $3 billion in trades in office. So some people are buying it. I just had to time this right.
I don't. Yeah.
So here's what our friend Peter Linneman says about buying office in this market. So he likes it. He thinks it's a really good price and really cheap. And now he's on a lot of podcasts. Look him up. He's a Wharton School. He's a PhD. This is a smart guy, and I've kind of follow him because he's entertaining as well as insightful. But, it's an interesting take. I mean, what about Calgary? I mean, you can buy office there for $50, $60 a foot, 35% vacancy. You can't replace it for $600. There's a way to get wealthy.
I have a very good friend who's bought 4 or 5 buildings in Calgary, and I told him when that market, if he bought it at $60 a foot, when it gets up to 120, get out, because it's once in a lifetime, right? And
it's going to go back to 600.
It's a round trip back to $60 a foot.
Guys, we started this we started this conversation about rising to greatness in the face of adversity. This is how you get great.
The challenge with the
or go down in flames, I guess.
The challenge with the market in Calgary, we've looked at a lot of those trades, and they seem compelling on paper, but you're buying a B-class office building, and you're paying $60 a foot to acquire the building, and every 5 years you're spending $60 a square foot to renew your tenant. It's, I like to say that, as an office building owner, there's times you cash checks, and there's times you write checks. And it just feels to me like that B-class market in Calgary is, there's a long cycle of writing checks ahead of you.
Yeah, well, I started in the business same time as Mark, as he said, and I was also a leasing agent on the ground for a dozen years, and the inducements do get pretty big. We were writing big checks in the early 80s for sure, and it really is an institutional game for the most part. So
Tony, with the fees they're paying in leasing, office leasing, I would still be in a leasing broker right now with the fees they're paying. I should get back.
Okay, so let's move on to industrial. This has been the darling of our industry for a lot of years. Everybody likes industrial. You couldn't go too wrong. You had, you saw lowest vacancy ever. Vancouver was one of the lowest office markets, and now, we've got vacancy. It's a new thing in industrial. They got this thing they call availability rates in industrial. That's if a building can be delivered in the next 8 months, so it's not just about extending inventory. And we got 4% across the board, and Vancouver, for the first time ever, not leading the world in industrial levels. Rental rates begin to fall. Of course, they rose from very, very low levels to very lofty heights, but they're falling significantly in industrial, and that's in every major market across Canada. And there's some sales, you go back, again, we're not going to get into these statistics, but they were in the high 3s, and now they're kind of in the low 5s. So they've really moved. So what's our barometer saying about industrial? Are we still buying industrial? What are we looking for?
I love industrial.
All right, there we go. And that's why you're first.
I wasn't even an industrial broker when I was in the business. Unfortunately, we haven't been able to do much in Vancouver, but we are very active in Toronto. I said we're building, have built, or in the process of building 5 million feet. And we started in that market in 2017, 2018, and we watched rents go they were at 5 net forever for 20 years. And all of a sudden they went up, and went to almost 20 net, and they've backed down a bit there, and more supplies come on. But I do like industrial. It's much simpler, and there's, if you build it right, like we don't build the big bombers, the 600,000 footers and up. We like the 200,000 to 300,000 foot buildings, though there's always the optionality to subdivide.
Richard?
Yeah, industrial's solid. I mean, it's flattened out, but it's solid. The challenge in the Lower Mainland is the cost of industrial land. I don't know if you're building in Greater Vancouver, but I can't make it work.
That's fallen too, though. That industrial land has fallen significantly. From 7-8 million an acre in some places, I think you're down around between 4 and 5. That's a pretty big fall from grace.
Yeah, no, I think, look, everybody loves industrial. I do think that there's a little bit of a risk, this whole tariff threat. It may discourage expansion by industrial companies in Canada.
Milos,
I think that's a bit of a threat.
Yep.
Yeah,
So
lease-
you're not building,
lease.
Richard, you're not building, but you have a portfolio.
We are. I mean, we're about to start in Calgary. I think we're going to make another trip out there and do one final gut check before we start, but we're about to.
Milos?
I'm least worried about industrial, generally speaking. So that's the one that we're building a lot, we own a lot, we're leasing it constantly, and as much as you're seeing that bit of a drop, it's from the tightest market that we've seen historically in that asset class across any, right? So even if you bake in the worst possible assumptions on absorption and supply, you're still in a pretty tight market and probably very healthy supply and demand dynamics. So I'm not worried the tariff issue is on our radar, and I think that's more on the manufacturing side, depending on the type of facility and tenancy you have. But broadly speaking, it's a sector that, low capital, good rents, reasonable returns. Like we're long industrial all day.
It's interesting with the two asset classes you're comparing. With office, you can't build office unless you get a pre-lease commitment. That's how the lenders view it. But with industrial, you can build on spec, both in Canada and the U.S. So that just shows you how the lenders view the risk with those two asset classes.
Yeah, it's interesting that the sentiment positiveness towards industrial and not so on office, because it actually is a fundamentally stronger market from the fundamentals of supply and demand, and industrial has really suffered, from a very, very rapid rise in rates up into the mid-20s. They're already down now into the high teens. That's a pretty big shift too. I would be worried about that, but yet the panelists aren't, so they still see industrial as strong. So I find that interesting. Just to finish up here, retail. Nobody here really a big retail investor, I don't think, but this is this I can tell you, although none of you are really retail investors directly or in any major way, but the general market loves retail. It is the darling of the investment group. Everywhere we go, do you have any retail is the question we get asked. And if you look at some of the quick fundamentals here, and we'll get into the questions in a second, Mark, you look at the retail vacancies are very low, and they've stayed low, and they've always been low. It's very hard to deliver new products to the market in retail because it needs so much land. Retailing hasn't affected it. Delivering to home hasn't affected it. And even with bankruptcies up a little bit, retail remains strong in terms of new store openings and fundamentals. So productivity, this is the number of sales per available retail. So as an asset class, vacancy rates, the inability to supply, we sell a lot of retail. They like it, but none of you guys are buying it. So interesting.
No, we love retail. We own retail in our portfolio. We bought retail. We build retail. It's competitive. We're not actively buying just because we haven't found any compelling returns. But I agree with your thesis completely. Everything you said there points to why retail is strong. I mean, the population growth has exceeded the additional supply of new retail. So one could argue the market's
Milos,
Well, two things. We're a big owner of retail, and we've got a partner in the room that I'm looking at right now that owns quite a bit. So Alberta and Ontario. So we own a ton of retail, and we mostly enclosed within Canada. And we are actually
that's legacy investments. I'm talking
legacy, but I'd say right now top conviction sector is actually retail for us globally. So in the US, we're hunting for platforms and we're looking at
That's
stuff in
great.
Canada as well.
So
Primarily open air, kind of more necessity based, but would we buy a mall today? Absolutely, if it's a good mall. Because we've had, with our stuff, we've had really good.
Great. Well, I didn't know that. I learned something today. We'll talk. Mark?
I actually would like to get retail, but Milos, if you have a lot of retail, those tenants are whiners, and that's why we don't like to have too much retail. But there's a big difference between an enclosed mall and a food anchored, and it's hard to build that product out there. And if you're going to buy it, it's at a premium right now.
Okay, well, we didn't have a lot to talk about in retail, and I wish we could spend more time on that, but we got to get through this. We only got a couple minutes left. Really just going to touch on alternatives. There's various asset classes here. This is hotels. They look pretty good right now. That's pretty much a specialized asset class. We got data centers, self-storage, cold storage, industrials, outdoor storage, a new asset class. Really quickly, one question. Let's go through really quick because then we got to wrap it up with the final question. Any of these asset classes you like? Milos?
Outdoor storage, sure, we own some already, I would argue. So to me, that's kind of a...
Is it a landhold thing, this new? iOS is a big asset class in the US now. There's like 25 new companies.
I kind of don't even see it as an asset class in Canada because it just kind of comes with some of our assets, and so we indirectly own it. I don't think it's really all that investable, but that and self-storage.
Sorry, Richard? Thank you.
Hospitality's coming off a record year. We'd buy more if we could find it at compelling valuations.
You have the Empress Hotel, correct? Yeah. Then business is good?
Record year.
Mark?
We're big in iOS sites, industrial outside storage in the U.S., and we're very active in self-storage.
Self-storage, yeah. Hard to find it, hard to grow it, but it's a great asset class once you're in it. Well, this is, we'll finish up. This is what my friend Peter Lindemann says about some alternatives. So finish up with that. And so that's the reminder. I want to ask you this last question. I mean, we've been through this really, really difficult period, and it doesn't seem from this conversation this is going to end anytime soon. So our industry is going to continue to suffer, face obstacles. What are you telling? I was watching the Super Bowl. It was terrible waste of my time. The only thing worse than the performance by Kansas City was the halftime performance, I think. But yeah, clearly I'm not a rapper. I prefer a country music artist. But at the end, it was over. Philadelphia did a great job. They had a fantastic win. They dominated a two-time Super Bowl champion that was going for a three-peat. It was overcome great odds. They really wiped them off the map. And the coach said twice in his post-game interview, he said, you don't achieve this greatness without having great people around you. And you all have great people around you. And what are you telling them these days? I mean, this has gone on a long time, and the mental strain and the continual work that doesn't turn into deals, the effort that goes into not making things transact. It's kind of a wheel spinning. That's a really hard grind on the people around you. What are you telling the young people today that are going to make you great, how they can stay motivated? Milos?
I fundamentally believe this, so it's kind of easy to tell people, but it's cycles like this, I think, make you a really good investor. And in 10 to 20 years, when you look back on your career, having worked through these tough times, I think makes you really good. So to me, it's roll up your sleeves and work through it. It sucks right now, but it won't suck forever, and real estate's cyclical.
So these lessons will make you stronger.
Yeah, and I think our message is bad market's not your fault, but failing to adapt to it and react to it is your fault.
Brilliant. Mark?
Young people are looking for direction and leadership. Every Monday morning, we have a town hall meeting from 8 to 9. Everybody's there. We've got 100 people on our team. They're very passionate. But you got to help them through this. And we go through everything that's happening in the marketplace, and we look for positive things, and we're trying to build on that. We got to get through this tough period. None of them have been through this before. Us old guys have, so we've seen it, so we got to help them navigate through it. Nothing stays the same. It will get better.
It will get better. Well, on that happy note, that's all the time we have. So thank you, panelists. Give them a big round of applause for their insights today.